Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites JugglingDynamite.com and VenablePark.com. Welcome back to the show.
Hey, Jim. Thanks.
U.S. inflation is at 5%, the highest it's been in 13 years. What kind of a story is that giving us?
Well, and Canada's was 3% in the latest data. So those are big spikes, highest since the peak of the last cycle, Jim, in 2008. And there's a lot of base effects in there. As we know, the big fall off in the first half of 2020. So we're comparing May of this year with May of 2020. So a lot of that is just rebounding from the plunge that happened in the months in between. But then the usual suspects are in there when you see inflation in some commodity prices has fed through, but also just things like transportation is up because of people going back to traveling. Gas prices have increased, of course. Also, things like apparel. People are spending a lot more on clothes now because they're starting to get ready to go back outside. And of course, things like car rentals, where, you know, the fleets of the car rental agencies sold off a lot of their cars in the downturn of the first part of 20, and therefore there's a lot less supply. So that's made used car prices higher because there's less coming onto the market for availability. It also means that if you try and rent a car now, it's more expensive. So some of that is what's causing the increase that we're seeing. But I think what's really surprising is not that we're seeing those numbers, but that we're seeing a lot of moderation already. So in other words, you know, we were expecting to see this spike in May and June and into June, and that's in fact happening. But we're already seeing a downturn in some of the leading indicators.
Danielle, credit card debt has fallen to something like a 6-year low. People have paid off their credit cards or they're not using them. Is that going to pick up again when the economy picks up?
Well, it could, but it's interesting because this is this savings compulsion aspect that we've been tracking for quite a long time. You know, the aging demographic, when people are already quite indebted, they have a typical tendency to mean revert towards trying to pay down their debt, which is considered savings. And also when they get extra liquidity like they did from the government in the past year, they've are directed that, and this has been a surprise to many policymakers. They were expecting that if they gave, you know, if fiscal payments were given to households, that we would see them spend a lot of it, and they have spent, and that's been evident in durable goods consumption, which was up to a 60-year high in the first quarter of 21. But what's more surprising perhaps is the amount of people that are saving, and that includes paying down credit cards. So, you know, something like less than 30% of the stimulus payments that have been given to households have actually made it into this new consumption, and the rest of it they've been using to either reduce their revolving debt or build up their savings. So that's something that we think is likely to continue. A lot of the forecasters are presuming that this really high level of consumption of goods that we saw in the last year, for the reasons that we spoke of, you know, the inability to spend on services, the pent up at home stuff, the refurbishing and making your place more user friendly since you're there more often. All of that was a sort of a short-lived phase. And then what we think is likely is that we're going to see a drop-off in the amount of goods consumption, because as I always say, there's only so many new kitchens and new gyms in your house and new cars and everything that a household can use, especially when they're highly indebted. And we see that with Canadians being, their debt to disposable income ratio is slightly down from the peak. So they have, a little bit, because their asset prices have gone up as well. So their balance sheet looks a little bit better than it did a couple of years ago. But ultimately our household debt to income ratios are extraordinarily high. And that suggests that we're likely to have a period where people continue with this compulsion to try and pay down their debt and get a bit of buffer, get some savings. And also with the median age, the growing, biggest growing cohort in the population is the over 65. And as I always like to mention, peak spending tends to be in the mid-50s. And people at 65 tend to spend about 25% less than people in their mid-50s. So there's a big drop-off in our interest in adding more goods as we age. And so although, the older groups tend to have the most wealth accumulated, the most savings, they also tend to want to spend the least. And so I think those forces are going to continue to mean less growth in the economy in terms of consumption than people are expecting or banking on. And also this continuation of wanting to build up savings.
The Bank of Canada is leaving interest rates at, I think, a record low level, saying they're not going to hike rates until the economy gets going again. Could that happen sooner than later?
Well, I think central banks in general are very concerned that, so they've been trying to create inflation, right? This is the whole thing, because we saw such a extremely deflationary episode in the first quarter of 20 when the economy shut down and demand plunged and everything went off a cliff. And this terrifies central banks, because central banks know that we are in a highly levered world economy with more debt at every level than ever before in history. And the only way that that's likely to be paid back is if we can see continually escalating income levels, right? So that your debt payments become more manageable. You can pay off what's owed. So if you get into a deflationary environment where incomes are not advancing, where, asset prices are not escalating and everything starts to flatline, and then indeed assets become cheaper, then all of a sudden the whole thing turns on its head and you get people waiting to buy because prices are coming down, not taking as much wild risk in financial markets because they are not terrified of losing purchasing power with their money if their money starts to become more valuable over time because prices are becoming less. So central banks are terrified of this idea that we could have deflation or disinflation, because they have really only one tool, and that is to, raise or lower interest rates. And once they've already lowered interest rates for 30-odd years, as they have, and they've already boosted consumption as much as they can, and now we're going into this natural phase of less consumption for many, many reasons. Now they're terrified of that. So what they're trying to do is talk up inflation. So they do this constantly, and at the same time, right now they're saying, there has been inflation, and they're happy to have seen the inflation that they have. But I think in their heart of hearts, they know they're looking at the same data that we look at, and they're realizing that there is a sort of a transitory nature to the spending that's gone on, and that when households are this highly indebted, and you're not getting jumps in wages, which you're not. This has not been an organic growth recovery. This has been about transfer payments from the government. So once you realize that spending is likely, short-lived, transitory, and that you're not going to have these continual bumps in the ability to spend or the compulsion to spend, now they're worried about how long this is lasting. And so they've already got the overnight rate at 0.25, right? There's not much more they can offer there. That's the lowest of the low sort of thing. And they're already doing billions and billions in this asset purchasing that they've been continuing now since, 2000 since the last recession. So with that in mind, they're going full out, and they know it. So they're trying to, again, encourage people to think that inflation is going to be prevalent, but not out of control. And so they're promising to be, here as a backstop to not raise rates and to keep things full of liquidity as much as they can. But the point is they're already doing that, right? So this is no new development. This is no new news. It's very evident in things like the Canadian banks, of course. They beat on their earnings reports in the last month because they had taken back out of bad reserves or bad loan set-asides that they had a bunch of money that they were concerned wasn't going to be paid back because of the recession and everything that was going on in the economy. And then fast forward a year to now, and they're saying, gee, we haven't had that many defaults. Consumers continue to pay their loans. Well, as a result, they've got this big buffer of cash. So they brought that back into earnings. But the reality of the matter is that they're also not seeing a big demand. They're not increasing their lending to the general economy at this point because it's like everyone who could borrow has already borrowed. Even with the change in the stress test lately for mortgages, everyone who could buy a house or get capital to buy a house has basically done it. And now the banks are sitting there with this growing amount of liquidity that was gushed into them from the central bank. And the idea was, we'll give the central bank thought we'll give the banks really preferential treatment and then they'll have incentive to turn around and lend out money. Well, they haven't lent it out nearly as much as central banks were sort of hoping. And now they're sitting there with this excess capital. At the same time, the courts have been closed. The collection agencies have been kind of dormant while people have been laid off, and all these bizarre types of income flows have been coming, not the traditional wages. So there's been this lull where people could extend and pretend and continue to keep up their payments, and there's been deferrals even of some payments, right? So all of this has really caused this halcyon period where the bankruptcy trustees are, with a fraction of the amount of work they anticipated they would have by now because of all these emergency situations and programs. But at the end of the day, the banks are now saying, well, we've got all this money just sitting here. We've got nothing really productive to do with it. So that's going to hurt their ROE if they don't start, either buying other companies with it or returning it to shareholders. So they're back to, how about we buy back up our shares? Well, that's on hiatus right now because the central banks told banks they weren't to buy shares or increase dividends during the recession. So they're sort of dying to get rid of some of this capital right now, and it's really, in a flat, very low yield environment, it's tricky for banks to find margin. They've been making money in these runaway capital markets, but that's come off the boil in the past few months. So they're starting to feel like pressure on how to deploy capital. Welcome to the real world, right? The rest of us that have capital have been having this strife and challenge for some time, because in a world where, good assets there's a lot of good assets or potential ideas, companies, properties that might be of value, but price is everything. And if price is ridiculously high, even the best of asset can be a horrible investment if it's priced terrible. So banks are sort of looking at, they're in the business of pricing risk and trying to figure out what they can do with this capital that they've been, like a foie gras goose just pumped full of, this stuff, and they're supposed to use it. Well, it's hard to use in this environment when everything is at crazy valuations. So at the end of the day, I think that the banks have taken out this cushion too early, and if the regulators let them go back to buying back shares, that's going to be also a longer-term capital devastating, because they're buying things, again, at the very cycle peak. And whenever people are buying at the very cycle peak, like households right now have the most equities as a portion of their household their household assets as at any time in market history. So even above the peak of 2000, today U.S. households have about 28% of their household assets in the stock market. And that the prior peak was 26% in 2000. So Canadian households have followed a similar pattern where, you've had a lot of people that it's like they thought it was sort of the easiest thing in the world to make money just buying anything and it goes up. And that's the environment. So again, banks have had that wind at their back in the last while. But as soon as that's what makes everything so entirely correlated, so that when everything begins to mean revert and go the opposite way, then everyone's, everything that was great luck suddenly becomes horrendous luck. Everything that was easy financially becomes very challenging financially. And that's where over-levered economies, companies, and households struggle.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, the XL Keystone Pipeline has been permanently canceled. Alberta invested over $1 billion in it. A government really can't write off a loss, can it?
Well, this is the malinvestment that has been incented by cheap funds and sunk costs. So all of these, Alberta being a classic example, the oil sands being somewhere where so much capital has been plunged into it over the past few decades to establish and develop this resource, that even though, the world has realized that most of that can't be used, because when we have carbon budgeting or emissions budgeting, this is the overall arching theme that has changed everything today. Whereas, back in the old days, 30 years ago, people were talking about growth and taking assets out of the ground without any sort of overall big cap. But once you get into carbon pricing or emissions pricing, carbon taxing, and you say, fine, that province has a budget of X, you're allowed to emit X, or this country has a budget of X, you're allowed to emit X. And if you go over that, you pay a heavy penalty. All of a sudden, the budget starts to look different, because now it's like, well, if we let you continue to sell that fuel, then other businesses have to give up. So agriculture, for example, won't be able to produce what it's used to producing, and it's going to have to cut back. And every other sector in the economy will have to cut back, because now we're all working within this one cap or budget. And so when it comes to something like the pipeline, of course, everyone, wanted to hear that the world had insatiable demand for oil sands, fuel, and that all we needed was pipelines, right, to get it to the coast or get it to the U.S. refineries. And so a lot of pressure there to continue funneling funds in there. And, an obvious signal was that the company could not actually get a private partner, right? The producer, TC Energy, that was building the pipeline, they were looking for a private partner, and no one was prepared to take on that risk and put in capital. So that's how they end up partnering with taxpayers, who unwittingly, $1.3 billion of taxpayer funds get funneled into this antiquated idea, which is actually not going to be able to fly long term. It's a bad investment. And the private sector knew that, right? The private sector has been aware of this for some time. And this continues every month. There's new, Suncor is announcing a strategy change, or, Exxon's got new board members, or all these things are happening. There's a massive shift going on in this industry, in this sector. And so the pipeline was obviously, it was revived for a short period of time by the Trump administration. But ultimately, it's never going to be something that we continue to funnel money into, because it's a non-starter for the reasons I just described. So anyway, it's too bad, because Alberta's having a hard go right now, and they can't afford to be wasting $1.3 billion. No one can right now. So they have to be much more intelligent about the things that they make these long-term investments in. And to some extent that's happening, right? There is a lot of more alternative energy being developed in the province. But I think this is a wake-up call to all governments, that when the private sector sees the writing on the wall, and they're already pulling out of all these projects and diverting their investment to renewable, sustainable fuels and or ways to transmit, smart grids, this sort of thing, then obviously that's the future. And the more that we keep diverting taxpayer dollars into the sunk hole of sunk costs, the worse off it's going to be.
Now, Alberta has announced that they're going to build a $1.3 billion liquid hydrogen plant. Is that the wave of the future?
Well, depending how they get the hydrogen, it could be. There's different sources of hydrogen, and some of them can be manufactured from, not from fossil fuels. And so that could be a solution for sure. It's part of it. The other thing is, again, there's so much talk. I put a interview on the blog this week with Mark Jacobsons of Stanford, because he is one of the founders of the Solutions Project, and he is one of the most accredited experts in this field. Apolitical named him one of the most top 100 influential people on climate policy in the world today. And he is an engineer who has developed all these blueprints for states, cities, municipalities, countries, him and his team. And so he gets very frustrated by the amount of non-experts that are given the mic across the world to say, oh, we don't have the technology we need to develop all these, alternative energy sources. We've only got about half of the developments required to make the transition, when that's blatantly false. And the evidence is clear that there's about 95%, and hydrogen is one of the transitions to get off of the old approach, the old fuel systems. So anyway, he explains in his interview, that's one of the reasons I put it on, about how the funding for so many projects comes from the traditional legacy oil and gas sector, and why that is a problem. Because again, although they can talk about all these alternative ideas in the future, what they still have to, they're still struggling with the weight of their sunk costs in these old sectors.
Now, Alberta says this plant is going to be carbon neutral. They're going to be using carbon capturing and so on. At least they're saying it's that way. Critics say you're using natural gas to produce it. That's still wrong. The thing is, it's a resource Alberta has a lot of. Why not use it?
Oh, because, again, back to carbon budgeting, Jim. The reality is that we can't use it unless we're prepared to close down every other sector. I mean, if you're going to take all of the carbon budget for that one, product to produce, from natural gas, and the emissions will leave nothing else for the rest of the economy, obviously that's not tolerable or intelligent. It's not possible. So again, people have to get used to this idea of the finite nature of the caps that have to be put on what we can emit, and therefore that dictates how much each sector gets to use. And it's an example, for example, in the crypto mining area, where places things like Bitcoin have been being mined around the world since about 2008, when everybody sort of didn't think about how much energy was required to create Bitcoin. And so 75% of it is currently mined in places like China, which have a heavy coal aspect to their energy still. Even though they're investing in a lot of solar and wind projects, they still produce a lot of their energy from coal. Well, of course, now the government there is cracking down on the mining activities that are going on for a couple of reasons. Number one, first of all, because they're having extreme heat there this year, as we are in most parts of the world, and as we do every year now, extreme heat related to climate. And so the air conditioning, for example, is being escalated greatly because people are trying to cope with this and that's putting strain on the energy system. They're having rolling blackouts, which are closing down factories in some areas because they don't have enough energy to actually run and produce products, which is very detrimental to an economy that's desperately trying to produce things for export, and keep civil rest in the country. And so this goes back to, there's only so much energy to use. There's only so much budget for emissions you can create in producing that energy. And if a sector like mining Bitcoin takes a ridiculously large share, now you got to make a choice. Are you going to continue to allow people to mine a cryptocurrency or produce food? And obviously at some point one is more essential than the other. And so this is all about this new way of looking at things. So indeed the Chinese government is now cracking down on the amount of companies that are allowed to be mining cryptocurrency there. It's just the same as the idea of who's allowed to, burn off fossil fuels. And the good news is that this may inadvertently help the world to transition, because people who want to continue mining cryptocurrencies are now, getting offers from places where they do have a lot of geothermal, or they do have a lot of emission-free renewable power, and they're saying, hey, well, we can move there, because obviously if we can't do it here and we want to keep doing it, or we need to invest in sustainable energy ourselves. So some of the companies that are wanting to do it are having to expend money on, solar or wind and that sort of thing. So ultimately, perhaps it'll help in this whole transition. El Salvador's president they have a lot of geothermal there for electricity from the volcanoes, and so they're now saying, hey, let's market to Bitcoin miners so they can come here if they're getting thrown out of places like China. So I think, everyone's kind of got the memo here that we need to figure out ways to work within emissions budgets, and it really is helping to sober up choices, and I think that's a good thing.
Ransomware and cryptocurrencies, what's the connection here?
Well, that's, of course, the currency that ransomware being this package, which is literally sold as a software package by illegal companies to say, here's the kit kind of thing. You can go and hold these companies hostage, where hackers break into your operating systems, your computer operating systems of various they can do it of all sorts of things. I mean, they did the Colonial Pipeline in America last month. They did JBS Holdings, which is one of the largest meat packing plants in the world. They held them for ransom and demanded payment, $11 million in payment this month. And so once you get in the grips of this thing, they shut down your systems, and, they say, pay us X. Well, they're all asking for payment in a cryptocurrency, in this case, Bitcoin, because that's very easy for them to, once they get it, to transition or to move it to somewhere else and put it into a wallet and basically make it more difficult for people to track the funds. But what I was saying also about this is that this is a kind of a new development, but we've also got a whole insurance sector that is now growing up to insure companies against cyber attacks. Well, if you think that insurance companies don't have a vested interest in trying to trace the money once it's paid, because they can recoup then if they have to pay out to a company to cover their loss because they paid a ransom, and now they have an incentive to go after getting that ransom back if they can, right? Same with the government. If they're going to be held hostage by these illicit activities, these criminals, all the big banks of the world have an incentive to now try and track money or control who's doing this and go after funds. So what I'm saying is it really is focusing the mind of the so-called legitimate economy and operations against these, quote, bad guys. And it's really bringing into, for crypto advocates, it's actually a really bad thing, because the more focus and attention that is, these criminals are using cryptocurrencies for illegal money laundering, for, underworld activities, for ransomware, for holding up legitimate organizations and shaking them down for money, then the more the world in general on every level starts going, okay, how do we go after these guys? And indeed, they, it's not just bad guys that can hire hackers and computer programmers. And of course, we saw that this week, where the Colonial Pipeline ransom people originally got $4.4 million paid by shutting down the East Coast pipeline. But this week, the government announced that they tracked $2.3 billion of that and got it back. 2.3 million of it back. And so, it just goes to show that it's not just, as I say, the more public, the more visible all this becomes, the more the world focuses on how do we curtail this activity, how do we force them to greener energy sources, or how do we stop ransomware from ransom attacks from happening in the first place, or if they do happen, how do we trace the money and hack it back? And that's really a lot of attention right now on that.
Now, with the bumpy road that Bitcoin's been on, apparently with the Colonial Pipeline hack, the FBI recovered much of that currency, but by the time they recovered the Bitcoin, it was worth $2 million less.
Oh, well, yeah, because Bitcoin's off it's about 50% lower than it was. You know, it was trading at 64,000 and it's now about 36 or something like that. So, you know, I was saying this week that this goes back to this whole, you know, reality that the people who are big proponents of it insist that it's a stable store of value. Well, clearly it's not. It has routinely crashed 70% repeatedly over the last decade, and it's most recently off, you know, 50%. Then they say, well, you know, it's secure. Well, clearly it's not secure because it's been hacked and stolen and taken, you know, wallets removed, hard drives lost. I mean, there's a whole bunch of things that have gone on. So it's not more secure than any other currency or other asset type. And then the other big thing is they all say it's a hedge. It's a hedge against, you know, the collapse of other things, or, you know, they want to say it's a risk haven, it's a safe haven asset like cash or U.S. treasuries or gold. Well, clearly it's not, because it's been trading exactly with market sentiment. So as everything else was going up, as jubilant and bullish as, you know, we're at record bullishness in participants right now, they all are, you know, convinced central banks will never let assets go down again. And so they're very, jubilant in their pricing of everything, and Bitcoin went along for that ride. So I say, you know, we have to watch the sentiment indicators, because Bitcoin is now directly correlated with the risk trade. So the fact that Bitcoin, you know, and other cryptos, it just happens to be the daddy, but they all trade together. So the fact that they all were at this really peak level a couple of months ago and they've come off dramatically, you know, that's an example of the fact that we could have seen already the peak of the inflation, the peak of the asset rising this cycle. And even things like lumber, you know, lumber had quadrupled into the spring, and in the last, you know, month is off about 30% as well. So there's another example where, yes, there was this underlying demand for housing, which was fueled by cheap credit, which was fueled by the mania to get out of cities caused by the pandemic, and then you have this, you know, this sort of voracious appetite for building materials, but at some point it becomes way overdone, and I think that's exactly what's happened this time. And also the commodities trader community, the speculation, the speculative longs have been at record levels in all of these things, like copper, like lumber, like, you know, plastics, all of it. And so, again, people misinterpret, just as they did in 2008 and 11, as if this big spikes in these asset prices is to do with demand, legitimate use, and it's mostly to do with speculation. It's mostly to do with people that are only there because they think it's going up, and many of them are highly levered in doing it. Like, there's some of these crypto shops which allow people to lever themselves up 100 times to purchase cryptocurrency. I mean, we've seen this kind of madness in so many other asset classes, and of course that means that those people have almost no tolerance for any price decline, because as soon as it happens, they're getting margin calls and they're, you know, eating whatever equity they have anywhere else, and that usually brings these big washouts. So I just think it's whether or not, you know, the underlying ledger is one thing, and indeed the blockchain is likely to last. I understand all that. It's the reality, though, is that the cryptocurrencies are just sort of a symptom of that. They're something that has become manic, that has become widely traded and used as a vessel of speculation, just like all the rest. And I think that for all the reasons we've discussed, that's likely to change again, and that we'll probably continue to see repricing, controls, regulation, clampdowns from all the parties that have an interest in that.
The U.S. Internal Revenue Agency is very interested now in your crypto transactions, where you're supposed to report anything over $10,000.
Well, of course, because they're looking for revenue in general, right? So again, these things are traceable, and there's more and more interest in cracking down, just as there's a now growing interest in tracking down tax evasion, collecting taxes that are due. We've had the lowest level of collection and prosecution in the tax system in, you know, many, many decades. And of course now with the obvious, need for more revenue in governments because they've handed out all this money, this is a no-brainer, right? Ramp up your investment in collection efforts, and you're getting something like $4 back for every dollar invested, and so that's a no-brainer.
Sure, Canada has something like $50 billion in uncollected taxes.
At least. I mean, we've been, ever since the Panama Papers, we've been aware that we're widely a safe haven for money on the run, for money that's hiding, for offshore, everything. I mean, we're like a poster child in terms of the world, and it's widely known. So it gets to be almost an embarrassment. Well, I think it's already past an embarrassment, but especially when the government is bleeding red ink left and right at every level. And then there's that great book which I'm nearly through at the moment. It's dark, it's hard reading, but it's Willful Blindness by Sam Cooper, and it's exactly about Canada. It's about, in particular, Vancouver and Toronto and Montreal, and how they've been this incoming flow of corruption and money laundering, the whole connection with casinos, the narcotics rings, the influx into our real estate market, why our prices have become so obscene, and it's all aided and abetted by lack of regulation, by some politicians who have literally been part of blackmailed or corrupted into the system. So this is Canada. This is little old Canada, and it's the same in every country around the world. We've had this period of great let's say laissez-fairness, where credit was billowing and people thought they were getting away with something. But once you get into the now everybody's got to pay phase, then everyone starts fighting for, who should cut what, who should pay, who has to give up. Once we realize that there's an end in sight, whether it's a carbon budget or whether it's a financial budget, all of a sudden fiscal requirements are restored, and then everyone starts looking at things that actually matter.
Danielle, thank you so much for chatting with us.
Hey, thanks, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.